And without any further ado, Ed Altman. Thank you, Ed.
Thank you, Dan. Thank you all for hanging in there at the end of a long day with really fantastic panels and speakers. One measure of how good a conference is if you're still awake by the late afternoon, or you're thinking about the weekend, or what you missed at the office today. I must say I'm a victim of that as well, but I stayed awake every single second of this, listening to the panels. And I think we need to thank mainly Dan Kamensky for not only thinking about the overall symposium, but the quality and the choice of panelists, speakers, individual, and the fireside chats. Dan, thank you so much. You did a great job. Also, I'm really honored and very pleased to be involved in the initiative that is now going on at Stern, particularly at the undergraduate level. But I've been teaching credit, bankruptcy, restructuring now for 40 plus years and at Stern. And the latest impetus in this area as a career path for students is unsurpassed in anything I've seen in the past in the last year and a half, mainly because of people like Dan and Matt Richardson and their mentoring program with sophomores, juniors, at the undergraduate level, as well as, of course, the graduates, which I've been dealing with for a long time. So again, thank you so much for that. At the end of the day, I'm gonna, since it is late, I'm gonna give you a couple of, you ever watch the highlight reels on some of the NBA games, or I like college basketball even better, and you kind of get a 10-minute summary of was a 3-hour game. So let me give you a little highlight reel, if you will, of some of the things I'm going to cover, and some things I'm going to point out that may be consistent or inconsistent with some of the things you've heard before. But I must admit, this last panel was fantastic. And I learned so much, and I've studied this market very carefully about what's going on today in the markets, whether it be the high-yield bond market, the so-called leveraged loan or BSL, bank syndicated loan market, or the direct lending market, which, by the way, together now account for something in the vicinity of $5 trillion. Now, if you heard the talk from John Cortese earlier today, he's mainly interested in investment grade, and understandably so. It's much a larger market. At the same time, all the action, in my case, is in the non-investment grade market. That's where the defaults come from. That's where the bankruptcies come from. And you probably know I love bankruptcies and defaults, because in order to understand what's going on, you have to have data. And not just data from practitioners, but data from research. So I'd like to give a shout out to 3 individuals and people and institutions that helped me in what you're going to hear in the next half hour or so. First of all, a lot of the data I'm going to use is coming from both the Kroll Bond Rating Agency, KBRA. It's an up-and-coming rating agency. You all talk about Moody's, S&P, and Fitch. They're not the only players in the market. And they're not necessarily the best players when it comes to the non-investment grade market. But they all contribute very much to what we understand about the markets. And KBRA has a special group now on direct lending. So I'm going to quote some of their statistics. Also, Bank of America, Yvonne, are you here? Over here, from Bank of America, she has supplied me with incredibly helpful data. And finally, my colleague from the NYU Law School, Michael Oregi, Mike is here, he has a fantastic new paper on the private debt market. It's the most in-depth study by far that I've ever seen. And I've actually leveraged off some of the data from Michael's market in some of my slides. So thank you very much for all of that. It really begins to make this opaque market that we talked about a lot less so and much more transparent, but still there's a lot to go in this area. And finally, thank you very much to the prior panel and other panelists on that discussion. So here's the highlight reel, and then I'll get to the actual data. Did you know there were more Chapter 11 bankruptcies in 2024 than any year, including the Great Financial Crisis? You may not have known that. Now, yes, it does include subsidiaries, so there might be 10 subsidiaries of a large company that went bankrupt. And I get a lot of my data, I don't know if those folks are here, from bankruptcy.com and New Generation Research. They were supposed to be here today, but I don't know if they are, so shout out to them as well. So that's one fact about 2024, and it's continuing in 2025. And did you know that the difference between the default rate on bank syndicated loans and high yield bonds is by far the largest I've ever seen? Normally, the correlation between default rates on bank loans and high yield bonds is over 0.9. They move together until 2024. So for example, the high yield bond default rate was 1.5% in 2024. The bank syndicated loan default rate, Ted Boster talked something about it. My numbers are a little bit different, but much higher. For example, 3 times higher. Why? It's the same basic investor firms, some not investors, but firms that are in the non-investment grade market. High yield, non-investment grade, or junk bonds or junk companies. And I don't mean junk in a pejorative way. Some of these are incredible, important companies. And they're not small necessarily either. The $1 billion high yield bond is not unusual anymore, issuance. So my numbers are 5.7% default rate on BSLs and 1.5% on high yield bonds. I've never seen such a difference. And of course, it's the reason of much higher interest rates and floating rate on BSLs and private debt, and fixed rate on high yield bonds. And a lot of those high yield bonds were issued during COVID when interest rates plummeted dramatically, and those bonds are not coming due for another 2-3 years. And so it's going to continue. This year, I'm absolutely convinced that the default rate on bank syndicated loans, maybe it won't be as high as 2024, but who knows, if Washington keeps up the way they're doing, it might be much higher. And I'm serious about that. So there's been a tremendous difference in default rates for the first time in just about any year that I can remember. I was going to ask a question of the last panel, so maybe I can present the question and ask you to vote on it as well as ask them. And I'm very happy that several of the panelists are still here. And I loved, I think it was Evans, is Evans still here? He might have left. Comment about race to the end and convergence between direct lending and bank syndicated loans in terms of the yields and the spreads that are decided on at the very end. So here's an observation, and I'd like you to think about the reason for the observation. Historically, the spread between high-yield bonds and treasuries of a similar duration is about 5%, actually 5.2%. So that's the risk premium that investors, less liquid than treasuries, of course, obviously more risk, default risk, liquidity risk, and refinancing risk. 5.2%. This past year, until maybe this past week, but even now, the spreads were under 300 basis points for high-yield bonds and about 4.2% for bank syndicated loans. Either 100 basis points or 300 basis points, 200 basis points lower than the historic average. So the question is, why? Why are investors only requiring 3% spreads when the historic average is over 5% in a very, let's just say, risky market, maybe not the average risk? This is last year. And I'll give you 3 possible reasons. There may even be more. First of all, the yield play. Interest rates are pretty high, historically quite high compared to the last 10, 15 years. And so maybe investors are fat and happy with a 3% spread when the yield is between 7 and 8% on high-yield bonds. So they'll accept that, even though the risk premiums are, in my opinion, much lower than the risk involved, the default risk involved. Second, the incredible growth of private debt. Does the private debt market, I wouldn't say dominance, but increase in being an available resource to non-investment grade companies, does that help drive down the spreads on BSLs and high-yield bonds? And the third is that the market is way overpricing the risk. I'm sorry, overpricing the health of the company and therefore not requiring the appropriate risk premium in terms of default risk on these companies. So 3 reasons. High yields, fat and happy, it's enough for them to get a 3% spread, even though the historic average is 5. The increase in private debt as an alternative source for non-investment grade companies, or the models, or the market in this case, at this point, is not correct. And I know some people think the market is always right. I don't believe that. I think many times, in 2007, the market was not right. And I believe in 2024, the market is not right either for the potential risk. And the risk is incredible increase in leverage in our system. And when you have a lot of leverage, like anything else in leverage, it means more volatility in good markets or bad markets. And will we have a recession? And what will be the impact on default rates, on spreads, and on asset prices if we have it? So those are the 3 reasons. Yield play, impact of private debt on spreads, and market underpricing risk. How many think it's the most important reason is the yield play? Interest rates are high enough. How many think it's private debt that is impacting the spreads? And how many think that the market is underpricing the risk? So the latter two have about the same. I personally think the problem is it's very hard to know the quantification of each of these on that, the fact that it's 200 basis points, and I'll show you this now, below the historic spread. Or is the risk not that high? Maybe that's a fourth reason. And that's why they're only requiring a 2%, a 3% spread. So that's one of the highlight reel. Another highlight reel that I'd like to point out is in the BSL market of a default rate, whether it's 4.7% or 5.7%. Oh, by the way, there are two ways to measure at least default rates, based on dollars and based on number of issuers. I don't know what you think is more appropriate. I like the dollar one as the criteria. So the dollar default rate on BSLs, in my opinion, was 5.7%. It was 7% on number of issuers, or 6 to 7%. It depends on who's counting the issuers and the size of the market. We're talking about a $1.4 trillion BSL market. Some people have it at 1.1 and 1.2. High yield bonds about the same, maybe a little larger. And Michael's O'Reilly's is the outlier, but maybe the most accurate measure of private debt. His estimate is $2.5 trillion, I think, if that's correct. So you have to read his paper, read his sources of data, and, of course, the definition of private debt. But his estimate is 2.5 trillion. Bank of America's is 1.475, and I think most people are in that 1.5 to 1.8 area. So, in the BSL default rate, take a guess what percentage of those defaults are distressed exchanges? Answer, 73%. It's the highest percentage in the history of those markets by far. The historic average of distressed exchanges as a percentage of total defaults, and we do count it as a default, is about 25 to 35%. Maybe 40% in a good year or a bad year, depending on what you think about distressed exchanges. Last year, 73%, and 64% of high-yield bonds defaults were distressed exchanges. So now the question is, I don't know if you remember, I think Josh, I forget his last name, from Carlisle, remember what he said? They're all going bankrupt. Remember that, his comment? Well, I think that's an exaggeration. But take a guess, historically, what percentage of distressed exchanges end up either in a bankruptcy or a missed interest payment and a forbearance, but eventual a bankruptcy, or a second or third distressed exchange? What percentage, historically, end up with a really negative event within 3 to 5 years? Answer. And this is new research. We haven't published it yet. So this is the first public setting that I've mentioned this. 58% had a negative, significant negative, and most of those are Chapter 11s or 7s. And I don't remember who I talked to on the panel, but yeah, it might have been Josh himself. He said, but that's history. The most recent ones, it's going to be much higher. So that brings up the question, if you are a creditor and you get a tender offer from Weil Gotshal or Kirkland and Ellis or whatever, who's ever Davis Polk or the like, And it says, we're doing a distress exchange. We want to change the contract that you agreed to when you loaned money to this company. And now we're going to offer you either cash, new debt, or equity in a company in a distress exchange. And your value that you get back is going to be less than par. So it's defined as distressed. And therefore, we call it a default. It's a different kind of default. Do you accept that exchange? You don't have to. You can continue to hold the old debt. Or do you accept it? And of course, if it's a distress exchange, it means that a significant number of creditors have accepted it, and it goes through. And then the question is your recovery rate. Well, someone asked a question before about what recovery rate. Yeah, I think it was Don Pimbo that mentioned recovery rates. Well, there are three types of recovery rates. And I use the price at default because it's most transparent. 30 days later is the CDS criteria. And of course, you don't know what it's going to be 30 days after when you get the choice of accepting a distressed exchange, if that's the reason for the default. And so you have to make a decision to accept it or not. Historically, most creditors accept it. It's a way of avoiding a bankruptcy. But if you accept it and then the firm goes bankrupt 2 years later, what's going to be your recovery rate on the fact that you now own a different piece of debt or you own equity in the company? Well, it's going to be much lower, for sure. And so we need to see the impact on recovery rates, because otherwise, how do you make a decision if you're a creditor to accept the distress exchange? There may be many reasons, documentation, collateral, and the like, but the bottom line is you're probably going to get back 50% of what you would have gotten if you sold the debt on the time of the first exchange offer. So that's another highlight reel, 73%, unprecedented, and it's only going to continue because the lawyers have figured out that this is a great way of keeping the firm out of bankruptcy. And anyway, the bankruptcies these days are very short in duration, mainly because of pre-range and pre-packs and the like. Last highlight reel question, and I'd like to ask it in the form of a question as well. I asked this to one or two of the panelists before, and that is the relationship between the credit cycle and the business cycle. So here's the question. Who leads who? Does the credit cycle lead the business cycle? Or, as most economists would probably have their opinion, if not their empiricism, would say, no, it's the business cycle that determines default rates, that determines credit opportunities. Or are they coincident? Do they move together? So who leads who? That's the question. So how many of you think the credit cycle leads in terms of changes and impacts the business cycle? Raise your hand. Okay. How many think just the opposite? The business cycle leads. And how many think they're mainly moved together? Okay. So I'd say majority of you said the business cycle leads the credit cycle. I'm going to show evidence just the reverse. At least I think. And of course, it's something that I've looked at only for about 50 years. So it's, it's not as maybe obvious if you look at the most recent situation. So let me just, rather in the interest of time, get to some of the data behind the highlight reel rather than all the data that I have. And the PowerPoint is going to be available on the website. Is that the way it is, Dan? Or Dan is going to hand deliver to your office next week. Oh, wait a second. Instead, I can show all the data. Can we stay till midnight? Okay, well, no, I guess not. Okay, so the statistics are going to deal with three main topics. One, the credit cycle. What is it? How do you define it? How do you predict it? Two, the private credit market. And a shout out to Michael again. I'm going to steal some of his graphs. Sorry, I'm going to cite some of them. And finally, we're going to talk about some current statistics and also this relationship between the credit cycle and the business cycle. So here's my very simple rendition of the credit cycle. Benign, interest rates are low, default rates are low, recoveries are high, lots of liquidity. That's my definition of a benign credit cycle. Probably default rates between 0 and 1.5% to 2%. Historic average default rates on high yield bonds, 3.3% per year. On bank syndicated loans, about 3%, slightly lower than the high yield bond market. So if you have 0 to 1.5%, that's a benign situation. Also low interest rates, lots of liquidity and the like. Average, well, that's related to history. So you have to understand history. You don't have to just look at what happened last year. You have to look at what's happened over the last 40 years. And then, of course, weight it by the size of the market in each period. Stress, we're talking about above average default rates, below average recovery rates, higher interest rates, and potentially a forecaster of a recession. And finally, a crisis. And I define a crisis of 10% default rates for at least 1 year and probably 2 to 3 years. And there are other definitions as well. Very simple. Howard Marks at Oaktree has written about credit cycles. Michael Gatto has written about credit cycles. Silver Point, is it? Silver Point. And, but I have a very simplistic way. And in the PowerPoint, we have quantitative definitions of default rates, recovery rates, required rates of return, the distress ratio, and liquidity. By the way, for those of you who are not familiar with the distress ratio, it's the percentage of high yield bonds or syndicated loans selling at more than 10% above the risk-free rate. And I coined that term back in 1990 when I was asked to do a white paper on the distressed debt market by a firm that maybe you probably never heard of called Foothill. And Foothill was an investment company in distressed debt, lender, et cetera, in 1990 that came to me and asked for this white paper because there was no academic work being done on distressed debt. And so I said, what is distressed? And they said, oh, you know it when you see it. I said, well, that's not good enough for a database aggregation. So they said, well, how would you define it? So I arbitrarily chose 10% above the comparable duration risk-free rate. Now, it could have been 12%, could have been 8%. But here's the deal. Distress ratio has a historic average of around 10% of the high-yield market. I'm not sure what it is on the BSL market because it's a younger market. I didn't have that. But it's probably close to that. And so the distress ratio, if it's high, it means the market is expecting more defaults. Or low, they're expecting less defaults. And finally, liquidity. How much new issues? And I particularly look at the CCC area. So to give you an example, historically, CCCs are about 10 to 12%, maybe a little bit more, of the high yield market in terms of new issuance on an annual basis. Currently, it's about 1%. I'm talking about for the first 2 months of this year. And last year, it was about 6%. So the market is changing. When we talk about high yield and distressed debt, we're talking about double Bs, Bs, and triple Cs. It's now much more oriented toward the double B market and much less in the triple C. So the market, in that sense, is thinking it's more risky. Otherwise, it would be just the opposite. I'm going to skip over this except to say, globally, we have increased leverage in the system dramatically. And these percentages are the percentage of debt, 4 different categories, as a percentage of global GDP. And we can do the same for the United States. And there's no question the biggest growth in leverage is coming from non-financial debt and government debt. Bank debt, insurance debt, etc., has leveled off because of regulation. Mortgage outstanding has leveled off because that was the crisis. So, dramatic increase in corporate leverage. Makes sense during low interest rate period. Doesn't make sense in high interest rate period, which we're in today. Look at the United States. Did you know that we have to pay $3 billion a day in interest? Close to $1 trillion this year in the weighted average interest rate on US government debt. $3 trillion. So they talk about, in Washington, lowering the size of government, etc. Well, there is some sense to that in terms of if it also lowers the amount of debt outstanding. I doubt that it will. And they're talking about all the panelists I heard today, including Mark Lasry, who I respect a lot for his incredible intuition on the markets as well as savviness, said interest rates are coming down. I don't think they're coming down. How could they come down when the US government, for example, needs to issue so much new debt? Do you think investors are going to accept lower interest rates? Sure, the Fed could lower it, but that doesn't mean interest rates will come down, except for the Fed rate, if you have a supply and demand dynamic with respect to government debt and corporate debt. Here's the size of the markets. 1.5 trillion high-yield bonds, leveraged loans. I don't know the exact number. I see 1.1 or 1.4. Ted, what do you think is about 1.4? 1.4, thank you. Exactly. So, okay, I buy that. I mean, look, the first 2 months of this year, there were over $100 billion of bank syndicated loans issued, right? You heard that in terms of directional. So it's a pretty big market, so it's hard to believe it's only 1.1 trillion. So I think it is 1.4, 1.5. And then we have direct lending. So we have 1.7, 1.8. By some estimates, Michael's estimate is 2.5 or 2.6, I think. Is that correct, Michael? And so there is some, but we know it's the biggest growth area. Here's your usual dichotomy of investment grade, non-investment grade. Here's the growth of the high-yield bond market. I got involved in this market in 1981 when I was asked by Morgan Stanley to opine to them, should they get involved in this new market called junk bonds? You know, it's junk. There's junk food, there's junk mail, junk bonds. So they really were concerned with getting their hands dirty with trading, underwriting, and doing research, which are the 3 pillars of investment banking, on this new market at that time. You know, Michael Milken, Drexel were the pioneers, and they were making 3% spreads on these issuance. Should we get involved? And I said, well, great idea. I'd love to do it. Do you have some data? And they said, yes, we've got some data from Drexel. And I said, I can't use that data. It's obviously not reliable if they're the market leader because they want to stimulate the market. So they said, well, can you build a database? So we started building databases on defaults and bankruptcies, which we continue to do in one form or another today. And so we now have databases that are really quite good on public junk bonds. They're quite good on BSLs, but they're not so great on direct credit yet. And I really don't know the bias here, but our latest estimate of the default rate on, not our, this is KBRA's, on private credit was 1.9% last year. BSLs, 4.7 or 5.7. How could they be that different? Well, you could say it's made up of different companies, but they're all non-investment grade. Yeah, there may be more double Bs versus triple Cs. They're all floating rate. So it has to be maybe something on how you define a default. So we know how to define a default in BSLs and high yield, but I'm not so sure we know how to define a default on direct credit, because direct credit has a lot more flexibility in forbearance, in PIK toggles. You all heard of a PIK toggle, right? You've got a bubble head. The company has the option to pay in interest, or if they don't have enough money to pay interest, they can pay in new debt. So I don't know, Ted, if you have any statistics, or anybody has it, what percentage of direct credit, private credit, are now paying their interest in the form of PIKs, payment in kind, as opposed to interest payments? Any ideas? Ted?
Actually not sure.
Let me make a guess. 15, 20% of the interest payments are now not being paid. And instead, they're paying it in new debt, increasing debt, which may or may never get paid back. I'm not saying that it's a great strategy for the company. That might be one attraction to go with a private credit as opposed to, would a BSL ever issue a PIK toggle? Probably not. So that's just one way. So my guess is the default rate on private credit, which may be still pretty good because they're very smart people running that company, but how can it be so much different than BSLs? They're both floating rate, both non-investment grade assets. Yes, we heard about the differences in potential credit quality. So we need to get better data on default rates. Here are some descriptive details coming from Michael's work. This is the size of the private credit market growing from 2018 of about 1.1 trillion to 2.6 trillion. This is Michael's data, so it's not mine, but I think it's very credible. Based on BDCs, non-BDCs, private credit, and private funds. So what is a BDC? Well, a BDC is, on one end, a company that lends money, but also you can buy their stock on the stock exchange. And you can get a very high yield. What's the average yield on a BDC? Dividend yield I'm talking about. Could be 7, 8, 9%. Hey, that's not bad for a common stock. The average common stock in the United States today is under 2% dividend yield. So that's great. How do they pay it? Well, you know, they charge 100, 200, 300 basis points more than, say, a BSL. They may be lending to, but here's the thing about BDCs. They need private equity. And they need private equity to do a lot more in the terms of leverage buyouts, and therefore needing more leverage. And there's this symbiotic relationship between private equity and private credit. So what's the outlook for private equity? Because that's going to help us determine the outlook for private credit. I don't know the answer to that, but I got to believe it's not so great with interest rates remaining high, valuations already through the roof, and of course, the big elephant in the room is if the economy goes into a recession. So I don't know the answer to private equity's outlook. If we had a panel on private equity, we probably would get pretty bullish forecasts, but it doesn't look like that to me, although I really don't know the answer to it. So that has something to do with the growth of private credit in the future. Here is a private credit fund structure schematic. It's very complicated. Well, I don't know how complicated it is, but there are a lot of feeder funds, either levered or unlevered, providing limited partnerships to the master fund. But one thing I want to concentrate on, and Michael has done some work in this area, it's very interesting, and you heard it somewhat from JP Morgan. The banks actually have an exposure to private credit. And one way of exposure is actually lend money to them or to buy them. Long-term loans, lines of credit, revolving credit. So Michael has an estimate that about, I don't remember, 450, 500 billion exposure, direct exposure of banks to private credit funds. Or it might even be much larger if, in fact, they begin to own them themselves, so their exposure is 100%, instead of whatever it is minus the recovery rates on potential loans that go bad. So what will be the percentage? I'm now dealing with the question of systemic risk. Systemic risk is very much related to banking. We had systemic risk in the great financial crisis because the banks were mainly, mostly all insolvent very quickly from 2007 to 2009. So what is the exposure of banks to private credit? And the answer Michael comes up with, and I think the numbers are probably quite reasonable, is around 500 billion, give or take 50 billion in direct exposure. And let's suppose we have a recession. I'm doing some stress tests now, and we have a recession, and we have very high default rates in the private credit industry. And what I mean by high default rates may be 6 to 8%, which is very high, for several years, 2, 3 years. So if you then do your math and you factor in a recovery rate, let's say it's 50%. By the way, there's a strong inverse relationship between default rates and recovery rates. I don't care about the sector that's going to impact it. I don't care about the capital structure that's going to impact it. I just know that when you have lots of defaults, you have low recoveries, and vice versa. I know that Oak Hill, right? You mentioned something very interesting, which I didn't know before, and it's probably quite right. If you have a lot more defaults, if you have a recession in the economy, you may even get larger firms defaulting than before when the economy is strong. And in that case, you might get higher recovery rates because they generally have better collateral. Well, I think that's true, but our data shows an incredible, very strong inverse relationship between default rates and recovery rates. So when you have lots of defaults, you have low recoveries and vice versa. That's supply and demand. And I think a lot of the distressed funds are just waiting for more defaults so they can buy distressed credits at much lower prices. So bottom line is, banks' exposure, even if they lose 50, 70, $80 billion, that's not going to destroy our banking system in any way. So I agree with Michael that systemic risk from private credit meltdown is not that serious. So I think that's helpful, because if the numbers were much larger, if the banks instead had $1.5 trillion outstanding to private credit in one form or another, then I'd begin to worry a little bit more. This shows private fund debt issued to private debts that have less than 50% capital ratios. And look at 2024, a big increase. So there's more risk now moving into more debt on the part of private credit as they get fat and happy after all these 10, 15 years of very high alpha returns. Bank borrowing from...
Can I just reflect one thing on the last slide? What is in dollars? Well, I guess relative to 2023, 2024.
No, it's not that much in dollars. It's just a big increase from what it was before. You're right, David. This is bank borrowing of BDCs. It shows, this is only through, you don't have 2024 yet, do you, on this? So this is drawdowns or non-drawdowns from banks. Okay, let's move on. I'm going to skip over some things. These are the 5 or 6 things that I look at in determining where we are in the credit cycle and where we're going. If I look at the high-yield bond market, things look pretty good. Low default rates, low required spreads, a distress ratio of about 4%. Historically, it's about 10. Lots of liquidity. Last year, close to $300 billion of new high-yield bonds. Maybe the recovery rate looks a little shaky. So things look good. But if I switch to BSLs, things don't look so good. Default rates are way above the historic average. Recovery rates are a little lower. Spreads are higher, but still below the historic average. Liquidity is good, so that's good. So I'm beginning to worry a little bit more, but none of the usual indicators are that bad in terms of either high-yield bonds or BSLs. But that was before the latest issues of the tariffs, inflation. You got the inflation numbers yesterday. I don't think they were terrific. So it was 0.1% less than what we expected. Next month, my guess is it could be 0.1 or 2% above what we expect. It's still pretty high, and interest rates are still very high. That's the main thing. But it is a reprieve anyway. Liquidity, quite good. So most of the indicators are not that seriously looking into the future. But none of these reflect a recession. Here's the numbers. You can do it when you want on how I think about default rates, recovery rates, and option-adjusted spreads, and a relationship to the benign average. It's too detailed to go into right now. Here's this yield spread analysis going back to 1997. So the average is 5.4% on high-yield bonds. It was 2.87%, 287 basis points at the end of February. What do you think it is today? It was 287. Vaughn, do you have the latest number? 340. Okay. So we've gone out 50 basis points on the spread. That's a big increase, but it's still way below the historic average, way below. And I think too much below. It should be higher even, but it's beginning to correct. And BSLs, it's 440 or so, something like that, spreads. That's capturing the risk a little bit more, but still below the historic average. So, there's some ways it can go before returns really get compromised.
I want to make sure.
Am I almost done?
I want to make sure we get some questions for you.
Oh, okay. Let me just end by showing default rate and recovery rate statistics last year. Here's the numbers I'm talking about. Here's the first 2 months of this year, in case you really want to be up to date, which I don't know how helpful it is. It's only 2 months. But you can see the difference between high yield bonds, 0.18%, and leverage loans, 0.44% for the first 2 months of the year. Much higher if you look at it by numbers. I think it's a little bit better than the way it was last year. Here are the numbers I'm talking about with respect to BSL. $82 billion of defaults, but 73% were distressed exchanges, and only 19-20% were bankruptcies. 82 billion is very high. 73% is maybe an outlier, but some people think that it's now the trend. So let me skip over some. Last thing I want to show you, the relationship between the credit cycle and the business cycle. So this chart shows, we got some music now to entertain you. The yellow bars represent recessions. The black solid line represents default rates on high yield bonds. We're going to do this now, default rates on bank syndicated loans. But what I want to point out is every recession, the last 4 anyway, default rates on high yield bonds start escalating. I don't have a marker here, but oh, I do have it. Start escalating from below to above the historic average 1 year, 3 years, 2 years, and it was about synonymous in the COVID. But in almost all the recessions I've looked at, default rates went from below to above the historic average 1 to 3 years before the recession. And of course, it peaks during the recession or just thereafter. So if we fast forward to the current situation, we see that default rates went from below to above in 2023, but it dropped in 2024. So it doesn't seem like that's a problem. But it is a problem, I'm sure, if I superimpose on this BSL default rates. So I'm thinking that the credit cycle, in my opinion, leads the business cycle, at least in terms of trends in default rates relative to the eventual recession. We had a blip against that in 2016. We had a big increase in default rates, mainly due to the energy crisis. So let me conclude by showing you, where is it? Okay, I have here the number of bankruptcies. So here's the latest 2-month number. It's a little bit down. These are the first 2 months of 2025 versus the first 2 months of every year going back to 2015. 998 Chapter 11s in the first 2 months of this year. Last year, 1270. So it is going down somewhat, but it's still the 3rd highest year since 2015. With that, I will conclude by saying, yeah, I'm usually bearish. I'm more bearish than bullish in my talks. There are some positive negatives, but I do think that the risks out there are much greater than the spreads are showing. And I think it's partially because of the impact of private credit, lowering the spreads that companies are being offered, so to speak, or are marketed by their bankers. Yield play could be an important one. And also, I would watch very carefully the GDP numbers in the next 2 quarters, because we won't know we're in a recession until at least next August. even though there'll be signs of it in the next quarter or two. And take a look at the forecast of the Fed from Atlanta. They're the only ones, and they did this a month ago, that forecasted a drop in GDP in Q1. And you have to take a look at what's involved in that formula. Thank you for hanging in there. Sorry about this.
If anyone has any questions for Ed, I'm sure we can do it after the conference. I'm going to invite Mark Heimowitz up just to conclude the conference. Okay. Ed, thank you so much.
Thank you.
So I can read a room. This is going to be very short, just concluding comments. And I'm really up here to make a pitch for the Creditors' Rights Coalition. But before I do that, I do want to take about 3 or 4 minutes to go over what I see as the themes throughout today's presentation and symposium. Because one of the most interesting things to me is when you put together a set of panels like this, each of the individual panels and panelists work together. So, you know, the current events panel, they all met and they discussed things. But each of the individual panels don't talk to one another. So when you end up with lots of different presenters, like Mark Lazary talking about the markets, and then Ed Altman talking about the markets, and you get these concurrent themes, it really actually is what, to me, delivers the most value. So, you know, just to start at the very beginning, it seems plain to me that everyone agrees that we're in a pricing situation where things are overvalued, where people are looking at differentiation